Nobody is prepared for what China is about to do. Not Wall Street, not Washington, not the average investor scrolling headline thinking tomorrow will look like yesterday. Because the biggest shifts in history never arrive with sirens. They arrive quietly while most people are distracted. And right now, the world is standing at the edge of one of those moments. This isn't speculation. This isn't hype. This is a warning hidden in plain sight. For decades, the global system ran on one assumption: China would play by the rules written by others. Manufacture cheaply, export endlessly, recycle dollars back into the system, and stay predictable. But something has changed. China no longer wants a seat at the table. It wants to build a new one. And when a nation with China's scale, discipline, and long-term strategy decides to move, the shockwaves don't stay regional. They travel through currencies, commodities, supply chains, and savings accounts around the world. Here's the hook most people miss. China doesn't think in election cycles. It thinks in generations. While others argue over quarterly numbers, China plans for decades ahead. And right now, its actions signal a shift away from dependency and toward control. Control over resources, trade routes, technology, and financial leverage. This is not an emotional move. It's calculated. And calculated moves are always the most dangerous to those who aren't paying attention. Look closely at the signals. Strategic stockpiling. Quiet accumulation of hard assets. Reduced exposure to systems it doesn't control. Expansion of influence where money, materials, and manufacturing intersect. These are not defensive actions. These are positioning moves. History teaches us that before power shifts, there is always a period where the signs are visible, but ignored. People don't fail because they lack intelligence. They fail because they underestimate change. And here's the uncomfortable truth. When China acts, markets don't ask for permission. Prices adjust instantly. Stability disappears slowly at first, then all at once. Wealth doesn't vanish, it moves. And the difference between those who suffer and those who survive is preparation. Not panic. Preparation. Because the greatest opportunities are born from moments that most people are too afraid to face. This is where motivation meets responsibility. You don't get to control what China does. You don't get to control global policy. But you do get to control whether you understand the game being played. You get to decide if you'll be early or if you'll be part of the crowd asking questions after the damage is done. Awareness is leverage. Knowledge is protection. And foresight is power. The next phase of the global economy will reward those who think differently. Those who question assumptions. Those who realize that when a giant shifts its weight, the ground moves for everyone. Ignoring it won't stop it. Laughing it off won't save you. But understanding it, really understanding it, can change everything. China is no longer content with operating inside frameworks designed by Western economies. Its recent economic behavior signals a deliberate shift toward reshaping global trade, finance, and resource flows in ways that reduce reliance on external monetary and political structures. This transition reflects a long-term strategy aimed at sovereignty over supply chains, pricing power in key commodities, and insulation from external financial pressure. Unlike economies driven by short political and market cycles, China operates on multi-decade planning horizons. This allows it to absorb short-term costs in exchange for long-term dominance. Such planning enables sustained investment in infrastructure, technology, and strategic reserves, positioning China to act decisively during global disruptions while others remain reactive. China's approach to reducing exposure to the U.S. dollar is incremental and calculated. Rather than triggering market panic, it is slowly expanding alternative settlement systems, bilateral trade agreements, and asset diversification. This method minimizes immediate backlash while steadily weakening the dominance of dollar-centered financial channels over time. China is prioritizing tangible assets, resources, infrastructure, industrial capacity, and strategic reserves over purely financial instruments. This reflects a broader economic philosophy that physical control offers security when financial systems become unstable. In periods of global uncertainty, nations holding real assets gain leverage, resilience, and negotiating power. As China repositions itself economically, volatility across currencies, commodities, and capital markets is unavoidable. These shifts do not represent random instability, but rather structural realignments. Investors and governments, unprepared for this volatility, risk misinterpreting it as temporary noise rather than a signal of deeper change. The greatest advantage in the coming economic environment will belong to those who anticipate structural change rather than respond to crisis. China's actions highlight the importance of preparation, adaptability, and strategic positioning. In an era of global realignment, resilience will favor economies, institutions, and individuals who understand the direction of change before it becomes obvious. China is no longer behaving like a participant trying to succeed within an existing global system. It is behaving like an architect quietly redesigning the system itself. For decades, China accepted the rules of global trade, finance, and currency dominance because participation delivered growth. That phase is ending. What we are witnessing now is not frustration or rebellion, but confidence. When an economy reaches sufficient scale, influence, and internal capacity, the incentive shifts from compliance to control. This is the moment China has been preparing for, and the implications extend far beyond its borders. The most important signal is not what China says, but what it does. Its policies increasingly reflect a desire to reduce exposure to external pressure points that it does not control. This includes financial channels, trade dependencies, technology bottlenecks, and resource vulnerability. These moves are often framed as routine adjustments, but taken together they form a coherent strategy, reduce reliance, increase leverage, and create parallel systems that function even when existing ones are stressed or weaponized. That is not the behavior of a system follower. That is the behavior of a system designer. Here is the hook many overlook. Systems do not change overnight. They erode gradually before they are replaced. China understands that abrupt disruption invites resistance, but slow structural shifts invite adaptation on its own terms. By expanding alternative trade mechanisms, encouraging non-traditional settlement arrangements, and strengthening regional economic ties, China is building redundancy. Redundancy is power. It allows a nation to walk away from unfavorable conditions without collapsing, something only system architects can afford to do. Another critical element is narrative control. China increasingly frames its economic initiatives as stability-driven, development-focused, and mutually beneficial. This is strategic. A system architect must attract users before asserting dominance. Infrastructure investment, trade connectivity, and long-term financing are not just economic tools, they are onboarding mechanisms. Once nations and institutions integrate into these structures, exiting becomes costly, and influence becomes embedded. What makes this transition especially significant is timing. The existing global system is strained by debt, political fragmentation, and declining trust. China is not attempting to overthrow a strong structure. It is positioning itself as an alternative while confidence in the current one weakens. That is how power shifts without formal declarations. When people stop asking who wrote the rules and start asking which system works, the architect wins. The defining question is no longer whether China will shape the future system, but how quickly others realize the shift is already underway. Those still viewing China as merely a large participant are analyzing yesterday's world. The architecture of tomorrow is being built quietly, strategically, and with intent, and history shows that by the time the blueprint becomes obvious, construction is already complete. China's greatest advantage is not cheap labor, advanced manufacturing, or even scale. It is time. While most economies are governed by election cycles, quarterly earnings, and immediate market reactions, China operates on a fundamentally different clock. Its economic planning is designed around decades, not years, and this long-term orientation allows it to pursue strategies that would be politically or financially impossible in short-cycle systems. That difference in time horizon quietly compounds into a powerful structural advantage. Here is the hook that often goes unnoticed. Short-term systems are forced to optimize for speed and popularity, while long-term systems are free to optimize for resilience and dominance. China can tolerate periods of lower growth, temporary inefficiencies, and even external criticism if those sacrifices strengthen its position 10 or 20 years down the line. This ability to absorb pain without changing direction is a rare economic weapon, and it becomes especially potent during periods of global instability. Long-term planning allows China to invest heavily in areas where returns are not immediate but strategic. Infrastructure, resource security, industrial capacity, and technological independence are pursued with persistence rather than urgency. These investments do not always deliver short-term profitability, but they reshape future bargaining power. When supply chains tighten, when capital becomes scarce, or when political tensions rise, the economies with long-range preparation gain options, while reactive systems face constraints. Another critical advantage of extended planning is coordination. Policies in China are designed to reinforce one another over time rather than compete for immediate impact. Industrial policy aligns with trade objectives. Financial strategy supports resource acquisition, and domestic development strengthens external leverage. This coherence creates momentum. While other economies shift direction with leadership changes or market pressure, China advances along a consistent path, allowing compounding effects to take hold. The real power of long-term strategy becomes visible during global disruptions. Crises expose the weaknesses of short-term thinking. Supply shortages, currency volatility, and capital flight tend to hurt economies that lack strategic buffers. China's approach emphasizes preparation rather than prediction. Instead of guessing when the next shock will arrive, it builds capacity to withstand multiple scenarios. That mindset transforms uncertainty from a threat into an opportunity. Perhaps the most underestimated aspect is patience. In economics, patience is often mistaken for passivity, but in reality it is leverage deferred. China can wait for favorable conditions, while others are forced to act under pressure. It can negotiate from strength simply by not needing immediate outcomes. Over time, this patience reshapes power dynamics, because those who control time eventually influence terms. As global economic volatility increases, the advantage of long-term strategic planning becomes harder to ignore. Systems built for speed struggle to adapt when conditions change. Systems built for endurance do not need to rush. They outlast. And in an environment where survival increasingly determines success, endurance becomes the most valuable asset of all. China's approach to de-dollarization is not loud, dramatic, or confrontational, and that is precisely what makes it effective. Rather than announcing a break from the dollar-based system and triggering global panic, China is methodically reducing its exposure in ways that appear technical, incremental, and easily overlooked. This is not hesitation. It is strategy. The most powerful shifts in finance rarely arrive as revolutions. They arrive as adjustments that compound over time until the old system quietly loses relevance. Here is the hook most observers miss. Financial dominance is not lost when people reject a currency outright. It is lost when they slowly stop needing it. China understands that the dollar's power comes from habit, infrastructure, and network effects, not just trust. So instead of attacking the dollar, it is building alternatives alongside it. Bilateral trade agreements settled in local currencies, expanded cross-border payment systems, and diversified reserve holdings are not symbolic gestures. They are structural substitutions. This gradualism serves multiple purposes. It limits retaliation, avoids market shocks, and provides plausible deniability. Each individual move can be justified as a routine risk management decision, yet together they form a clear directional shift. By spreading these changes across time and institutions, China ensures that no single action becomes a trigger point for systemic backlash. This is economic pressure applied without visible force. Another overlooked element is optionality. By reducing dollar dependence incrementally, China gains flexibility without sacrificing access. It does not need to abandon the dollar to weaken its influence. It only needs alternatives ready when conditions demand them. In periods of stability, the dollar remains useful. In periods of tension, alternatives become leverage. This is how power is accumulated quietly rather than declared loudly. There is also a psychological dimension. Markets are conditioned to respond to shocks, not slow drifts. A sudden announcement would provoke fear and resistance, but a gradual shift encourages complacency. Over time, participants adjust behavior without fully recognizing the transformation underway. By the time the implications are obvious, the infrastructure supporting change is already embedded. What makes this strategy particularly effective is timing. Rising debt levels, financial sanctions, and politicization of payment systems have increased awareness of currency risk worldwide. China is not creating concern. It is responding to it earlier and more systematically than others. By positioning itself as a first mover in alternatives, it gains influence over standards, norms, and usage patterns that will define future trade relationships. The key insight is this: de-dollarization is not an event, it is a process. China is not racing to the finish line, it is changing the route. Those waiting for a dramatic break will miss the shift entirely, while those watching the plumbing of the system will recognize that the foundations of monetary power are already being rebalanced, one quiet decision at a time. China's growing emphasis on physical assets reflects a deep skepticism toward financial promises in an increasingly fragile global system. In an era where value is often represented by digits on a screen and confidence is sustained by belief rather than backing, China is moving in the opposite direction. It is choosing ownership over assumption, control over trust, and substance over symbolism. This shift is not accidental. It is rooted in a clear understanding of how systems behave under stress. Here is the hook that reframes the entire discussion. Financial instruments work best in stable environments, but physical assets matter most when stability breaks down. Paper claims depend on enforceability, liquidity, and trust. Physical assets depend on access and control. China's strategy recognizes that when uncertainty rises, contracts can be challenged, currencies can be diluted, and counterparties can fail. But resources, infrastructure, and production capacity do not vanish in a crisis. They become more valuable. This mindset explains China's persistent focus on securing energy, metals, food supply, and industrial inputs. These are not speculative investments aimed at short-term returns. They are insurance policies against disruption. By locking in supply chains and controlling critical nodes of production, China reduces vulnerability to price shocks, trade restrictions, and geopolitical leverage. The payoff is not immediate profit, but strategic certainty. Another often overlooked advantage of physical assets is pricing power. When demand tightens, those who control supply influence terms. Financial wealth can evaporate in volatile markets, but resource ownership can dictate outcomes. China's accumulation of tangible assets positions it not just as a consumer in global markets, but as a negotiator. That distinction matters when competition intensifies and cooperation becomes conditional. There is also a credibility factor at play. Physical assets signal commitment. Infrastructure, manufacturing capacity, and reserves cannot be reversed overnight. They anchor long-term relationships and discourage instability by raising the cost of conflict or disengagement. In contrast, financial positions can be unwound quickly, often amplifying volatility. China's preference for physicality reflects a desire to anchor its economic power in structures that endure. Perhaps the most important hook is this. In a world overloaded with leverage and debt, real assets act as a stabilizing force. They provide optionality during inflation, scarcity, and systemic resets. While others rely on financial engineering to manage risk, China is building risk into the physical world, where it can be measured, managed, and defended. As global confidence in abstract value weakens, the importance of tangible control rises. China's strategy reveals a fundamental belief: when systems are tested, reality matters more than promises. And those who hold reality in their hands shape the outcomes everyone else must accept. Market volatility is no longer a temporary disruption to be smoothed out by policy interventions. It is becoming a permanent characteristic of a system in transition. This is the hook many still refuse to accept. Volatility is not a malfunction, it is a signal. As China repositions itself economically, price swings in currencies, commodities, and capital markets are not random events. They are symptoms of deeper structural realignment, where old assumptions collide with new realities. For decades, global markets were conditioned to expect stability supported by coordinated policy, predictable trade flows, and dominant financial institutions. That environment rewarded leverage and short-term optimization. But when a major economic power begins adjusting its role, dependencies shift and certainties dissolve. China's strategic moves introduce friction into systems that were built on smooth continuity. Friction creates volatility, and volatility exposes weakness. Here is the uncomfortable truth. Volatility punishes those who mistake stability for permanence. When systems change, prices must reprice risk, and repricing is never calm. Currency fluctuations reflect shifting confidence. Commodity swings reveal supply insecurity. Capital flows respond to uncertainty faster than policymakers can react. These movements are not signs of chaos. They are the market's way of recalibrating to a new balance of power. China's role in this process is critical because of its scale. Even small adjustments in policy, demand, or reserves can ripple across global markets. When such adjustments are sustained rather than episodic, volatility becomes embedded. This environment favors preparation over prediction. Those waiting for markets to settle down are assuming a return to conditions that no longer exist. Another key hook lies in how volatility redistributes wealth. Stable markets reward efficiency. Volatile markets reward positioning. Those with strategic buffers, flexible capital, and long-term perspective gain advantage, while those dependent on smooth continuity face stress. China's approach accepts volatility as a cost of transformation rather than something to be avoided. By contrast, Systems built to suppress volatility often amplify it when control finally slips. Volatility also reshapes behavior. Businesses shorten supply chains. Investors seek tangible value. Governments prioritize resilience over growth at any cost. These shifts are not temporary reactions. They are adaptive responses to a world where uncertainty is structural. China's repositioning accelerates this adaptation by forcing market participants to confront risk they previously ignored. Perhaps the most revealing insight is this: markets fear volatility only when they do not understand its source. Once volatility is recognized as a feature of transition, rather than a flaw, it becomes navigable. China's actions are not designed to calm markets, they are designed to secure advantage within them. And as long as the global system continues to adjust, volatility will remain the environment in which economic power is tested, transferred, and ultimately redefined. The defining advantage in the coming economic environment will not belong to the largest economies or the loudest institutions, but to those who prepare before pressure forces their hand. This is the hook most people learn too late. History does not reward reaction, it rewards anticipation. As China advances with deliberate foresight, it exposes a growing divide between prepared actors and reactive ones, and that divide will determine who maintains influence and who absorbs the cost of change. Prepared actors understand that structural shifts announce themselves quietly. They rid policy direction, capital flows, and resource allocation rather than headlines. China's behavior illustrates this principle clearly. Its actions are not responses to crisis. They are preemptive moves designed to shape conditions before crises emerge. By the time others recognize the shift, China has already secured options, buffers, and leverage. Reactivity, by contrast, is expensive. Economies that wait for confirmation often find that confirmation arrives in the form of disruption. Supply shortages, currency stress, and capital flight do not offer time for careful planning. They force rapid decisions under unfavorable conditions. China's approach minimizes this vulnerability by ensuring that critical capabilities are in place long before they are urgently needed. Another powerful hook lies in adaptability. Preparation is not rigidity, it is flexibility built in advance. Systems designed with redundancy can adjust without breaking. China's long-term investments in infrastructure, industrial depth, and strategic reserves give it room to maneuver. When conditions shift, it does not need to improvise solutions. It selects from options already available. That distinction is the essence of strategic power. Prepared actors also control narrative timing. They act early, quietly, and without spectacle. Reactive actors move loudly, under pressure, and in full view of the market. This difference matters. Early action preserves negotiating strength. Late action invites scrutiny, speculation, and cost escalation. China's ability to move before consensus forms allows it to set terms rather than accept them. Perhaps the most important insight is that preparation compounds. Each early decision increases the effectiveness of the next. Infrastructure supports trade. Trade supports currency influence. Currency influence supports financial autonomy. This compounding effect is invisible in the short term, but decisive over time. Reactive systems, trapped in crisis management, never achieve this momentum. As global economic alignment continues to shift, the gap between prepared and unprepared actors will widen. Those who invest in foresight, resilience, and strategic depth will absorb volatility and convert it into advantage. Those who rely on stability returning will find themselves adapting to a world already shaped by others. In an era defined by transition, preparation is no longer optional. It is the currency of survival. So remember this moment. Remember that you were warned before the headlines screamed it, before markets reacted, before people said, "How did this happen so fast?" Because the truth is, it never happens fast. It happens quietly until it doesn't. And those who prepared won't be surprised. They'll be ready.